Order. Welcome to meeting number 81 of the House of Commons Standing Committee on Finance, pursuant to Standing Order 108, bracket 2. The motion adopted on Wednesday, January 12, 2022, the committee's meeting to discuss the inflation in the current Canadian economy. Today's meeting is taking place in a hybrid format pursuant to the House Order of June 23, 2022. Members are attending in person in the room and remotely using the Zoom application. I'd like to make a few comments for the benefit of the witnesses and members. Please wait until I recognize you by name before speaking. For those participating by video conference, click on the microphone icon to activate your mic, and please mute yourself when you are not speaking. Interpretation for those on Zoom. You have the choice at the bottom of your screen of either floor, English, or French. For those in the room, you can use the earpiece and select the desired channel. A reminder that all comments should be addressed through the chair. For members in the room, if you wish to speak, please raise your hand. For members on Zoom, please use the raised hand function. The clerk and I will manage the speaking order as best we can, and we appreciate your patience and understanding in this regard. I'd now like to welcome our witnesses. With us here today from BMO Capital Markets, we have Michael Gregory, who's the Managing Director and Deputy Chief Economist and Head of U.S. Economics. From Desjardins Group, we have Jimmy Jean, who's the Vice President of Strategy and Chief Economist. Welcome. And from National Bank of Canada, Stéphane Marion, who's the Chief Economist and Strategist. Thank you for joining us today, witnesses. We are going to now provide you with an opportunity for opening remarks up to 5 minutes. We will start with Michael Gregory from BMO Capital Markets, please, for 5 minutes.
Thank you. Mr. Chair and honorable members, thank you for the invitation to appear before you as part of your study on inflation. My name is Michael Gregory. I'm the Deputy Chief Economist at Bank of Montreal, and I will focus my opening comments on the Canadian economy and touch on a little bit on the U.S. inflation situation. And the bottom line is Canadian inflation is coming down after peaking at 8.1% last.
Yeah, this it's difficult for our members to see the witness speak because this monitor is not on. I'm wondering if we could pause for a moment until that's rectified.
Okay, we are having some technical difficulties yet with that monitor, so we'll suspend for a minute and see if they can get it done by then and then get going. Okay, we're back, and we will have, looks like technical challenges have been fixed. Mr. Gregory, the floor is yours.
Thank you, Chair. Canadian inflation is coming down after peaking at 8.1% last June, the highest in 4 decades. Data released this week showed the annual change in the CPI at 5.2% for February, and more progress looms. Some of this will be due to base effects. In the wake of Russia's invasion of Ukraine, last spring exhibited the biggest 3-month surge in prices in 40 years at 11.6% annualized. And this won't be repeated this spring. And indeed, the latest 3-month trend is running under 2% annualized. However, the latest figures are being flattered by lower energy prices. Looking at underlying or core inflation, whether measured by the CPI median, the CPI trim, or the CPI excluding food and energy, The yearly changes are all tucked just under 5%. And importantly, the latest 3-month annualized changes are running in the 3% range. The latter are much closer to the 2% target, but further progress is still required. Fundamentally, inflation continues to run at an above target pace, and it accelerated in the first place because of an imbalance between demand and supply in the domestic and global economies. After the onset of the pandemic, the demand for commodities and commodity prices were initially depressed, but they eventually recovered in some cases quite sharply. This trend was exacerbated by Russia's invasion of Ukraine. It also didn't help that extreme weather and disease were impacting global agricultural supply. There was a surge in the demand for goods, partly because you couldn't spend on services owing to restrictions. The strong demand butted against global supply chains that were still reeling from the pandemic, resulting in shortages and distribution backlogs. This caused many goods prices to spike. Then, as the Canadian economy reopened, there was a surge in the demand for services, but many service providers were constrained by lack of labor. This caused some services prices to spike, with the resulting increased demand for workers applying upward pressure on wages amid the lowest unemployment rate in half a century. Overall, Canadian demand was so strong that businesses were able to pass their higher labor and other input costs onto their customers. Facing these mounting inflation pressures, the Bank of Canada began tightening monetary policy a year ago to dampen demand in the economy so that supply could catch up, and it's catching up. After 8 consecutive rate hikes and a cumulative 425 basis points of tightening, the Bank of Canada paused earlier this month. Monetary policy works with a lag, and the bank was keen not to weaken demand more than is necessary to restore price stability. We expect the pause will continue for the rest of this year. Nevertheless, there's a significant chance that the Canadian economy will still see a downturn under the weight of monetary tightening, given near record high household debt burdens. However, we judge any downturn will be mild, given the support provided by $350 billion of excess savings amassed by households, lingering pent-up demand, particularly for services, and a sturdy labor market. As for inflation, we expect the annual changes to be in the 3% range by the end of this year, down from around 5% currently, and well on track for 2%. Finally, with President Biden visiting Ottawa today, it's worth mentioning how America's fight against inflation compares. The annual change in the U.S. CPI was 6% in February, down from its 9.1% peak last year. U.S. core inflation was 5.5%, but the 3-month trend is proving to be more stubborn than Canada's, still running in the 5% range. Definitional differences account for some of this, but demand south of the border is proving to be more resilient in the face of Federal Reserve tightening. As such, yesterday, the Fed raised policy rates another 25 basis points. We expect one more rate hike this spring. Given what will be 500 basis points of cumulative tightening and the recent headwinds coming from banking sector stress, the U.S. economy is more likely to suffer a mild downturn this year, which will weigh on the Canadian outlook. We also expect 3% range U.S. inflation readings by year end, like Canada. That concludes my comments. Thank you, and I would be pleased to discuss this further in the Q&A.
Well, thank you, Mr. Gregory. And now we'll move to the Desjardins Group, and we have Jimmy Jean for 5 minutes, please.
Merci beaucoup.
Thank you. It is my turn now to thank you for inviting me. I'll begin by talking about the global economy. The theme this year is one of resilience. We were expecting a downturn, certainly, but according to the data we have, it's less that we got back in January and February. It shows that this inflation is less pronounced than expected. We've even seen signs of improvement since the start of the new year, including in the service sector. Labor markets surprised many with their strength in January and February, and this was the case both in the U.S. and Canada. That said, A slowdown is still anticipated with the onset of a recession this year. In the U.S., the housing sector has been hit hard by the rate hikes. We're talking a contraction of 50% if we look at the new applications for house ownership, and we're starting to see signs of weakness in the demand for residential construction workers. So we may see job losses in the future, which will be added to those that we are currently seeing in both the technology and financial sectors. Of course, the current turmoil in the banking world will have at least some permanent damage. U.S. financial institutions were already in the process of significantly tightening credit conditions, and this trend is likely to increase. There is little doubt that these dynamics will dampen investment and job creation. It's still too early to tell to what degree, but it's a little more certain that the smooth slowdown that the Fed had hoped to orchestrate will be viewed more and more as an achievement. Here in Canada, there were fewer positive surprises, not that we didn't have any, but it was more nuanced. If we exclude the momentum in job creation, economic growth surprised economists by stagnating in Q4 2022. Inflation and the real estate market have also generally been on the decline. Canadian household consumption is experiencing ups and downs. For example, Ontario experienced its largest drop in consumption in Q3 22 since 1992, if you exclude the pandemic. However, more recent indicators show some recovery at the Canadian level, influenced by auto shipments, among other things, as supply chains improve. This is likely to be a temporary effect, however, and several surveys confirm that Canadians' appetite for making major purchases is at particularly low levels. As mortgage holders renew their contracts at higher interest rates, the additional drain on their disposable income will require them to restrict their spending budgets and dip into their savings for those who do have accumulated savings during the pandemic, which is not all households. In short, discretionary consumption will be affected. Income will also be affected for some households. For example, those with occupations and sectors vulnerable to the real estate correction and interest rates could experience financial difficulties. The rise in insolvencies that we are currently observing in both households and business, well, that too will continue. The problems affecting banks outside of Canada could be an additional factor, prompting financial institutions here to exercise greater caution, which would be obviously reflected in credit growth, including business credit, which has up to now been fairly resilient, although the Bank of Canada has likely completed its rate hike cycle. Our base case scenario assumes that the interest rates will remain high at these high levels until the end of the year, according to the information received. Combined with the quantitative tightening, which we believe has more teeth here than the U.S., the conditions are in place for Canada to enter a recession in the next few quarters and for the unemployment rate to begin to rise. The unemployment rate is expected to end the year at 6.9%, up from 5% in February. The labor shortage could help mitigate the effect of the decline in aggregate demand on employment. And so for this reason, this recession is expected to be small in historical terms, but it must be recognized that current global financial events highlight a downward balance of risks. While Canada's banking system is on fairly solid footing, the financial crisis of 2008-09 is a reminder that Canada is not entirely immune to the indirect economic repercussions that typically occur in such an episode. As far as inflation is concerned, this should continue to moderate, but in our opinion will not reach the 2% target before next year, particularly due to persistent inflation in the housing, food, and service sectors. Still, The 2 to 2.5% range we expect for inflation at year-end should give the Bank of Canada enough comfort to start gradually easing monetary policy, including ending quantitative tightening. In our base case scenario, this monetary easing, which the Fed is also expected to contribute to in 2024, is what begins to lay the foundation for an economic recovery. Thank you, Mr. Jean.
We are going to now move to National Bank of Canada. I have Stéphane Marion. And just before you commence, Monsieur Marion, just like to first for Michael Gregory, if you could just move your boom on your mic a little bit down. Is that correct? Oh, higher, a little higher. I'm sorry, I apologize. A little higher. Yep. Would that be better? Okay. And in terms of the pace of your speaking, gentlemen, if you could just not go so fast, because we have the interpreters and they're gonna, they're trying to keep up, and it's difficult work for them. So the clearer you can speak and at a reasonable pace, that would be best. So, Monsieur Marion, for 5 minutes, please. Oh, I think you might be on mute. Well,
it's on his boom mic.
it's on your boom mic. On your boom mic, it might be where is there a switch?
On his wire, maybe.
Or on your wire?
Try to have him unplug and
Okay, can you unplug and replug, please? Unplug and replug? Oh. Okay. If you can unplug and replug, maybe your headset, that may help. Okay. So you must be able to hear us, Monsieur Marion? We'll give it another. We can't do it with those headsets, right? No. Okay. Yeah, Monsieur Marion, we only have certain approved headsets here for Parliament, so I'm not sure if. Yeah, we will give you a call. So, just stand by, and you'll be getting a call here from our technical department. So, members and witnesses, we're going to start into our first round of questions. And if we do get Monsieur Marion back on, we will interrupt at one point and allow him to make some remarks and then get back into questions. But we'll start with the first round right now, and we've got the Conservatives MP Morantz for 6 minutes, please.
Thank you, Mr. Chair, and it's very nice to have our esteemed witnesses with us today. I think I just want to start with, I guess, sort of the elephant in the room, which has to do with what's been going on in the banking sector, mainly in the United States, the catalyst of which was what happened with the Silicon Valley Bank. I just wanted, since this is a public meeting, if you could just give some reassurance to those who may be watching that Canadian banks are not at risk, and that the Canadian banking system will remain on solid ground despite what's going on internationally. Any one of you could take that.
Yeah, I can start. I think what we're observing, it's important to realize what we're observing in the United States really starts with very idiosyncratic factors and conditions affecting specific banks. And, we're talking about a banking system with 7,000 banks. It's not the same type of management that you're going to have in a system that have 7 major banks or financial institutions. So there were regulatory gaps. There was obviously the effect of very fast rising interest rates and some troubles in managing that risk in certain banks' balance sheets. obviously combined with bank run, an electronic bank run, which goes much faster, as we discovered, than those long waiting lines. So all those factors, I think, combine to produce what we're seeing. And then there's the confidence aspect that produces fragilities elsewhere. But in the case of Canada, our system has been, I think, consistently demonstrated to be resilient. That was the case even in 2008, 2009, which was orders of magnitude more complicated, featuring credit issues, toxic assets. And our financial system ended up being quite resilient. We ended up importing the negative effects on our economy, but our banks were sound. And if anything, they've been reinforced by very tight regulation and very sound regulation since then. So I'm not concerned that we might see something like this in Canada. However, what's going on certainly means that the credit is going to be slowing down further. It was already slowing down in the U.S. It's going to slow further. We might see that as well in Canada, as we see a bit of prudence on the part of certain financial institutions. Yeah. And so it reinforces the idea that we are going to see a recession as a result.
Okay, thank you for that. Now, last fall there was an article in The Economist that was published assessing housing risk, and it actually ranked Canada as number one in terms of housing risk. Netherlands was second, the United States was seventh, Italy was 17th. And the article said that bring this all together, all the ingredients for a deep housing slump are in place. This time, though, it's likely not to be led not by America, but by Canada, the Netherlands, Australia, and New Zealand. Economists at the Royal Bank expect the country's volume of sales to plummet by more than 40% in 22-23, exceeding the 38% drop in 2008-2009. That article was published in October of last year. I'm wondering if you could comment on whether or not you agree with that assessment, and whether 6 months later we're seeing that prediction in reality. Any one of you could take it.
Monsieur Gregory, you need to unmute yourself.
I'm sorry, that's a classic mistake. I apologize for that. There's no question that the Canadian housing market is correcting. We're seeing on a nationwide basis more than double-digit declines from the peaks we had. But it's interesting, though. A couple things. Number one is, even though home sales are falling, suggesting that demand for homes themselves have fallen in the wake of higher interest rates, that the availability of homes in terms of is also falling commensurately. There's not a lot of forced selling out there. There's not a lot of people stretched beyond their means, and I think because of that, this isn't a sort of a 2008-2009 situation. Canadian financial institutions are very prudent lenders. Canadian households tend to be very prudent borrowers, which was not the case in the United States, as you know, during the Great Recession and the global financial crisis that preceded it. So I do think, yes, we're getting a correction. It's going to be a drag on economic activity. It will likely continue to contribute to the risk of a downturn. But I do think it is manageable, it is containable, and so I'm not at all worried that this is going to spark an even larger problem in the economy.
Thank you.
Maybe if I can add to that.
Monsieur Jean, yeah, we're done with the time right now for MP Morantz. And before we go to our next questioner, which is Liberal MP Baker, we're going to try again with Mr. Marion, see if it works this time, see if we've got those technical challenges fixed. If
can you hear me now?
We can hear you. So 5 minutes.
I didn't hear you.
Oh, okay. Yeah, mic a little bit. Raise your mic. Yeah, You got
Better, better.
5 minutes. I don't know why you can't hear us.
No, I can hear you. There's a...
Okay.
Appel au règlement, Monsieur le Président, l'interprète.
The interpretation's impossible because of the sound quality.
Okay.
Because your mic is open.
Oh. 5 minutes now, Monsieur Marion.
I apologize. So, en espérant que vous pouvez m'entendre,
I hope that you can hear me. I'm here to complete the presentations made by my two colleagues.
and inflation is a lagging indicator that reflects the previous mix of fiscal and monetary policies. That said, far from it from me to lecture on how best to navigate a pandemic environment in context of dysfunctional global supply chain and acute geopolitical stress.
C'est moi.
La bonne nouvelle, c'est qu'à la suite
There's
des...
The good news, Mr. Marion,
speed that you're going at, but
Non, c'est l'interprète signale.
no, the interpreter is pointing out that it's the sound quality that's causing the problem.
challenges with the sound quality.
I can just make myself available for questions if you want.
Okay. I think they can hear the sound. I don't know if...
Push it out.
We're-
Push his boom mic out. Let's try that.
Okay, can you push your boom mic out a little bit, away from your mouth? Yeah.
How is that?
Okay, and also in terms of the pace of your speaking, please, if you could just slow it down a little bit, and that will also help with the interpreters. And maybe
Sure.
we could try again for the next. Let's see how things go, and we'll see if this works or not. Okay, go ahead.
Donc,
So the good news is that further to the changes made by the financial institutions, inflation is going down. I have some hope that we will get through this.
I remain convinced that the main challenge to keeping inflation at an acceptable level is to tackle the poor productivity performance of our economy. Le Canada est tout simplement à la traîne en ce qui concerne la croissance.
Canada is lagging behind. On a point of order, the interpreters point out that it's impossible to work.
Yeah. Okay. All right. So maybe we'll try this. Okay. So, Monsieur Marion, en français, please.
So in French, Mr. Marion,
That may be a little easier on the interpreters. It may work. So,
Je vais parler des 5
so I'm going to refer to the 5 graphs that I distributed.
what did you say?
Can you confirm
Have
that
you
have
got?
charts
Have you received the slides? Yes, everybody has received the slides. Yeah.
Okay. First slide. La situation de la récession
The pandemic led to the situation where households have been able to deal with the loss of labor shortages so that the available income has shot up both in Canada and the United States. So this is an unprecedented event combined with a monetary policy that was very flexible. We have witnessed a context where the production capacities of the economy, as we see on the second slide, is going much stronger than that of the supply. So inflation is now standing at 8%.
I believe we're okay. Yes, please continue.
Inflation, after hitting 8%, is now going down to 5.2% currently, excluding the mortgage interest rates. Canada is one of the rare countries where the monetary policy can have an impact on inflation because we're going to be excluding mortgage interest costs, and inflation is now standing at 4.8%. I hope that this will go under 3% by the summer. I'd like to now turn to slide 4, the perspective on home prices.
des maisons pendant la pandémie aux États-Unis a augmenté de 45%.
The interpreter apologizes, but I must stop due to lack of good quality. sound.
Au Canada au cours des derniers trimestres, la baisse du prix des maisons est maintenant observable.
Marion? Yeah, well, we still the sound is not of good enough quality that we can continue. Okay.
I apologize about that. I'll just be there for questions.
Okay, merci. Okay, so we are going to get back to questions, and we were going to the Liberals and MP Baker for 6 minutes, please.
Thank you very much. Merci beaucoup tous les
Thank you to all the witnesses.
I wanted to start by asking Mr. Gregory if you could comment on the issue of the resilience of our banking sector here in Canada. I think there's many Canadians who are seeing news about the volatility in the banks globally and stories surrounding Credit Suisse or Silicon Valley Bank in particular. I think many Canadians, I think many people in my community in Etobicoke Centre are concerned about or questioning whether the banking system here in Canada is stable. So could you speak to the resiliency and strength of our banks and financial institutions here in Canada?
There's no question that what's happening south of the border is a major source of uncertainty. And it's not just the institution that gets mentioned a lot, the couple that collapsed a couple weeks ago, but this is rippled through to the entire sort of mid-range banking segment, smaller and regional banks that are all experiencing some degree of liquidity pressures, exiting of deposits will affect the supply of credit in the U.S. economy from this particular segment. And to put that in perspective very quickly, more than 2/3 of the credit that goes into commercial real estate in the United States comes through smaller banks, not the top 25. So, there's going to be some shakeout from this further. The important thing to keep in mind, though, is north of the border, Canadian banks, are considered by organizations such as the World Economic Forum to be among the safest and the soundest in the world. Canadian banks are very well capitalized. Any kind of metrics they're supposed to have, they're running at or above whatever kind of domestic or international standards are required. They're well regulated and, importantly, well run. And so it's true that in a global issue, it's going to affect everybody. But even as we saw in the global financial crisis, credit continued to flow in the Canadian economy, and I think that is an important testament just to the resiliency of the Canadian banking sector.
Thank you very much for that. And I'm wondering if, Monsieur Jean, si vous voulez rajouter quelque chose sur...
Mr. Jean, do you wish to add anything to that? A lot of my constituents have been asking me about the resilience of our banking system, particularly given the situation that we're seeing with Credit Suisse and Silicon Valley Bank. What would you say with respect to the resilience and stability of the financial institutions here in Canada? As I said earlier, we don't have a banking ecosystem that is similar to that in the United States. We have regulations that are quite strong and are enforced, whereas in the U.S., the regulations made under the former administration were designed to loosen up the system. We don't have the same structure here in Canada, and we see what's happening in the technological sector. So the diversification of deposits, the matching, we don't see this in Canada. And moreover, capitalization is what's important. And indeed, the Canadian industrial sector, the debt in Canada is high, but we do have a much more solid banking system here than elsewhere. We're not concerned about what's happening. We're not concerned that the same scenario will repeat itself here in Canada. We don't have any incidents of that. Perhaps in 2009 we saw that the banks resisted, but they did feel the indirect impact of what was going on globally. But as for the solidity of Canadian banks, there is no problem, including for the Desjardins Group. Thank you.
Could I come back to you again on in your opening presentation? You spoke about what contributed to inflation in Canada, around the world, but particularly in Canada and the United States. Could you recap for us what some of those factors are? And in particular, what I'm interested in is, could you recap what those factors are? What is it that caused the spike in inflation? And I have a follow-up question if we have time. About a minute and a half left.
Sure. Well, clearly, it was an imbalance between demand and supply. And we go back to, hundreds of years of economic research or economic theory that talks about when demand is greater than supply, you end up with upward pressure on prices. That was the case in broader commodity prices as we recovered from the initial onset of the pandemic. And then afterwards, we ended up with Russia's invasion of Ukraine. And that part of the world is a major producer of virtually every major commodity. And so that further worsened that problem. We had the situation where the pandemic limited spending on services. Therefore, there's a lot of spending on goods. And people were buying things for the home instead of going on vacations. That further snarled global supply chains. And then finally, as we reopened the economy, and there's a lot of pent-up demand for going to restaurants, going on vacations, getting haircuts, and all of a sudden you ended up with a tremendous amount of pressure. At the same time, many service providers were having a difficult time filling the jobs. I was out in early in the after the reopening, and where restaurants were only open will be closed a couple days a week because they couldn't have enough staff to run open up every day. So that all just contributed to this upward pressure on prices, and fortunately, a lot of those pressures are now starting to turn the other way. So the inflation prospects are pretty favorable.
Thank you very much. Thank you.
Members, before we go to the block and Monsieur Savard-Tremblay, we are going to try one more time with Mr. Marion. What he's done is he's turned off his screen. Now he's not there. Okay, so we're not going to try with Monsieur Marion. Okay, listen, I guess when it rains, it pours. What I would like to say is for Mr. Marion, he will be able to send in his remarks, his opening remarks for members, for analysts, for our report. As well, members, you will have the opportunity, if you would like to send questions to Monsieur Marion, then you can do that and get his responses back in writing that can also then be submitted to the analysts and for the report. Madame Chatel on this? Yeah, oui.
Thank you, Mr. Chair. All of the questions that we're putting to Mr. Gregory and Mr. Jean are also relevant for Mr. Marion. So could I suggest that he respond to us in writing to the questions that we're asking today?
Once we get him, we'll ask him if he would be able to do that for us. But he will also get the questions. Clerk, if we could send him the questions that have been asked. Okay, that will happen. Yeah, MP Fast.
I have a similar concern. I'm here to ask Mr. Marion questions, and I'd like to have our analysts or whoever's responsible for getting Mr. Marion online to keep trying. So, because we do have a total of 2 hours, and if we can get him back online, I'd really appreciate it, because I do have questions specifically for him.
Yeah, MP Fast, thanks for that. We have been trying. So what we were trying to do right now, is we were asking Mr. Marion to stop his video feed. So we thought maybe that would be able to provide clear voice, so the interpreters could do their job. but we do not have them on screen right now. But I guess we will keep trying, Clerk, and see if what could be done. Okay, we have stopped time during this conversation. Now we're going to the block, and Monsieur Savard-Tremblay, please, for 6 minutes.
Merci, Monsieur le Président.
Thank you, Mr. Chair. I'm pleasure to be here to replace my colleague from Mr. Colleague. Mr. Marion, this wasn't personal. I didn't want to boot him out of this meeting, so I'm sorry about this. Mr. Jean, you didn't have the time to complete your opening statement, so in my time I'd like to give you a chance to complete it. Oh, thank you. I was concluding by saying that the decreases that we expect to see will have an impact on the economy, and the economy will be robust because we expect the central bank will be very prudent, and we won't be seeing what we saw in the last cycle. We'll see a normalization of interest rates, and that should enable us to be able to get the economy back on its feet and the real estate market as well. We're a few days away from the next federal budget. Most political parties are waiting for this. Do you have any examples? You did deal with some examples, but do you have an idea of some items that could be put in the budget that would be beneficial given the current difficult context? And, well, yes. What's delicate right now is that we have high inflation still. It's going in the right direction, but it's higher than what we'd like to see. So we have to be cautious in the choice of policies to ensure that the Bank of Canada is not put in a difficult situation. In terms of support for vulnerable households, well, we saw what happened in 2022. It was good. The federal government and the provinces helped those people who were having trouble paying rent, putting food on the table. And given this was a situation that was totally out of the control, it does the idea of giving support to people to enable them to breathe back then was a good thing to do. But these were one-time measures, and it was reflected in the budget. The budget over the next few years will account for inflation going down and not make the types of support that we had in the past an everyday thing. That being said, in everything that deals with these emergency measures, well, we've seen scarcity in housing. We've seen we need about a 50% increase in construction startups in order to stop this negative impact on affordability. So we're very far from achieving this right now. And what we do foresee is that there will be a slowdown in construction. And so we need policies to get things going, create housing, affordable housing in particular. That's pressing. And we also have to look at what's going on with the Inflation Reduction Act in the United States. This measure in the U.S. is one element that's going to attract investment, and we need to protect ourselves. There's a lot of potential, but the future may be somewhat uncertain because of this U.S. Inflation Reduction Act. And I represent Saint-Hyacinthe, and Saint-Hyacinthe often has the lowest vacancy rate in Quebec. Normally, I sit on the International Trade Committee, and we're looking into this U.S. Inflation Reduction Act. We want to deal with some protectionist measures that will have an impact on all of North America. But should we imitate this model? President Biden talks about tax credits for investment, and they've really looked at the transition to clean energy. Should we imitate that trend here? I'm not saying that we should imitate this on a one-for-one basis, because we have to remember that the U.S. economy and its production capabilities, well, it doesn't compare at all to Canada's, and we might find situations where there's a critical mass that's attained in Canada and economies of scale that can be achieved, which we can't compete with. So if we try to imitate this act, I think that's not something we can do. We have to instead look at where Canada has advantages compared to the U.S., and we do have some in terms of the quality and expertise of our labor force, and we have advantages. Well, we have certain sectors looking at, for example, lithium battery production and recycling. Thank you. And
MP Blakey for 6 minutes, but just before you begin, MP Blakey, we are not going to be able to get Monsieur Marion on with us here today, but members can pose questions, and we will ask Monsieur Marion for his opening remarks, and to be able to also send him out the questions that members have, so that he can provide some answers. And now to MP Blakey for 6 minutes, please.
Thank you very much, Mr. Chair. Mr. Gregory, I wanted to circle back to a comment you made previously. You had said that for the most part, Canadian mortgage holders aren't stretched beyond their means, and I just want to test that claim against some of the reporting out that major banks have done recently about their mortgage book. We know that variable rate mortgages represent a significant percentage of mortgages held in Canada, that about 3/4 of those are on fixed monthly payments, and that a majority of those now have reached their trigger point, where none of the agreed upon monthly payment is going to the principal, but it's all going to interest. And in fact, in some cases now we're seeing negative amortization by banks, effectively extending the amortization period by adding on the amount of the interest that's not covered by the monthly payment to the principal amount. And it seems to me that this is a significant point of stress within the mortgage system. It hasn't come due yet because some of these, there isn't an obligation to kind of renew the terms of the monthly payment if it's on a 5-year term until the end of that term. But I do think this is a point of concern, and I have a few questions in this regard. The first, I would ask if you're confident that Canadian banks are acting within their established regulatory authority and engaging in this practice of negative amortization, or I guess just the extent to which this is a creative solution by banks, because I think, even just last year, there were very few of these mortgages that had reached their trigger point, or if this is an established practice that's just seeing a lot of activity because of the current economic conditions. My second question is if you think that there's any either further policy intervention or actions required in the private banking sector, or whether there's public policy actions that you think would help to address this growing concern within the Canadian mortgage market. And finally, I guess I am curious to know what the analysis is over the next 5 years or so, what the expectations of banks are. Are these folks that banks anticipate will likely default when their variable term mortgage comes up for renewal? Or what would have to change between now and then in order to ensure that that banks aren't simply delaying defaults by engaging in this practice rather than stopping them altogether?
A couple of comments. Firstly, my initial reference to households not being as stretched, that was a comparison, say, to U.S. households during the global financial crisis and the Great Recession, that situation. But there's no question that as these mortgages are reset and renewed, that potentially is going to add to more headwinds on the economy. In fact, that is probably one of the key reasons why the Bank of Canada paused in its rate hikes, realizing that there's going to be a period here where many Canadian households are going to face higher mortgage interest payments as their mortgages are either renewed or their rates are reset. And they're going to have to adjust accordingly in terms of their spending patterns. The key thing to keep in mind as well is that for many years now, we've been, the financial system's been originating mortgages, and the government's been, agencies have been insuring them with this notion that there was a stress test, and a pretty onerous stress test at that in some cases. So it should be the case that many of these households that are now going to face higher mortgage interest payments, in fact, that scenario has already been played out in terms of do they have the financial resources to take care of that? Will they have to make adjustments? Will Canadians potentially start eating out less a little bit and maybe not going to the theater as much, or whatever the case may be? The answer is yes. But then again, that is precisely what the mechanism is here in terms of trying to slow the economy down, to broadly reduce demand, is to have that happen. And as my colleague Mr. Jean mentioned, the interest rate channel works very effectively in slowing down the Canadian economy for that particular reason.
So that we have a clear answer on this point, are you confident that banks are acting within their current regulatory authority to engage in the practice of negative amortization that they're using to keep these mortgage holders in their home?
That's not really my area of expertise, so I can't really sort of comment on that, unfortunately.
Monsieur Jean, j'ai une trentaine de secondes qui me restent.
In the 30 seconds remaining, Mr. Jean, do you wish to share your perspective on this issue? I would say perhaps that can we correct what's been done in the past? That would be difficult, but I think that the United States are less subject to the same situation because they can have long-term mortgages. We can't. We have 5-year terms. And in order to ensure that we have 10, 30-year mortgages, well, this has been discussed in the past, but we do see the impact of not having this in a mature market. It would enable us to deal with those issues.
Members, witnesses, we're moving to our second round of questions. Right now we are starting with the Conservatives, and welcome to our committee, MP Gray. For 5 minutes, please.
Thank you, Mr. Chair, and thank you to the witnesses for being here today. My first questions are for Mr. Gregory at BMO. One of the comments that you had made during your opening address talked about record high household debt burdens. And we know that CIBC has said that 1 in 5 of the mortgages that they have in their portfolio are in a position where the borrower's monthly payment was not high enough to even cover the interest portion of their loan. Do you happen to know at BMO if there are similar numbers that you're seeing there?
I'm not familiar with those figures at either institution or my own, quite frankly.
Great, thank you. So one of the things that you had mentioned as well is that you were talking about increasing of interest rates and how this slows the economy down efficiently and effectively, and you had made reference how households might make different buying decisions and what they might do. At the same time, part of this is as people are renewing their mortgages, then their mortgage payments are higher. So with the increase of interest rates, is it not true that in fact the banks themselves are the recipients of increased revenue based on the increase of interest rates?
Again, that's not my area of expertise of how sort of banks generate their revenues. But obviously, Canadian households are going to be stressed to some degree as they make these choices. But the thing I will come back to is the fact we've tested this. This is why we have a stress test. This is why we have one of the safest and soundest financial systems in the world, is because we take account of these potential problems. And now, higher interest rates are going to come home to roost. And I think for the bulk of mortgages, there'll be some adjustments that are going to have to be made, but those adjustments are all doable, and that's the important thing.
Thank you. So, as a senior economist with BMO, do you advise the senior leadership team and the board of directors on economic issues? Do you advise them and give them your thoughts on maybe ways that the financial institution might want to look at risk mitigation and sort of help with the direction as to the decision of BMO?
I personally do not do that. It's possible that the chief economist, Mr. Douglas Porter, may in fact be involved in more of those. But we do provide information through the reports that we publish, which are available publicly, and I do meet regularly with various people throughout our institution, as well as our clients, to give them our opinions and our insights, and hopefully have them all make better decisions.
Are you concerned that defaults will go up?
Well, I'm always concerned when the economy looks like it may be headed to a downturn, there's always some fallout from that. There always is when there's a downturn. The good news is that downturn is going to be mild by historical standards. And to put that in a little bit of a context, we officially are looking for negative growth in the second and third quarter of this year, but a peak to trough of just about 2 to 3/10 in terms of a net decline in GDP. While that may barely satisfy the technical definition of a recession, it's not going to generate the kind of strains on credit worthiness that more typical downturns would
Thank you.
Generate.
When you said the word fallout, does that mean people losing their homes? Is that what you meant by fallout? Do you believe that more people will be vulnerable in losing
By fallout,
their homes?
I mean implications for credit deterioration, credit worthiness, from the whole gamut of all the borrowers in the Canadian economy, both consumers and businesses.
And foreclosures as well? I mean, you're talking about people's credit history being potentially harmed, and maybe not. You're not saying that you're expecting insolvencies to go up. Is that what you're saying? That it would be more just affecting their credit history?
What I'm saying is that we are going to have a kind of weakness in the economy that should have a minimal impact, because it's not going to be a typical recession. It's going to be a very mild one. There's a tremendous amount of support for households in terms of $350 billion of accumulated excess savings. Some of that, unlike U.S. consumers, they've actually started to tap that, not Canadian consumers. Our more conservative bent, I suspect, has us stashing that away, potentially for a rainy day. And so I think
Thank you. Thank you, Mr. Gregory. Thank you, MP Gray. And now to the Liberals for 5 minutes. MP Chattel, please.
Merci beaucoup. Thank you, Mr. Chair. My question is for Mr. Jean. Thank you to all our witnesses for coming here. Mr. Jean, you said earlier that you talked about the Inflation Reduction Act in the U.S., and I really liked your comments. You said that this is that in Canada we need to invest in clean technologies, and it seems to me this would be a great opportunity I don't think that we can risk missing this boat, this economic turn around. So this is a great opportunity for Canadian businesses. You got my curiosity when you said we can't imitate the U.S., but we do have strengths here in Canada that we have to bank on. You talked about critical minerals, our expertise, our labor force is very educated, among the most educated in the G20. Could you please elaborate further on this point, Mr. Jean? Absolutely. When we look at the transition economy, we do have advantages. Look at our energy production, such as in Quebec. We have electricity, hydroelectricity that is relatively inexpensive. So we have some natural advantages. We're a player amongst the countries that are focusing on clean energies, but we can't sit on our laurels. We know that hydroelectricity, with the rapid decrease in the cost of solar and wind power, that hydroelectricity will be challenged. It will become more and more difficult to compete with these other technologies. So we have to be very active, increase our production with respect to clean energy, wind and solar, not only in Quebec but elsewhere in Canada. So that's an example. We can't just sit on our laurels. And also from the supply perspective, we have to ensure that our equipment is going to be designed to be used with these new technologies, such as wind power and solar power. We need to develop the grid further. But the U.S., which is a much more productive society, historically speaking, has production gains that are much more than ours, even without government assistance. Added to that, they're going to be able to give tax credits, so it'll be difficult for Canada to compete with them if we don't have a response to that, and if we don't target areas where we have niches, where we have comparative, where we do have sectors such as the recycling of batteries. The demand for the electric battery will be booming. There'll be a huge need for recycling. So in Canada, we need to position ourselves so that we have to be a real hub for the recycling of electric batteries. And so we have to be able to respond to that. And we have to be able to respond to this act. And also, we have to bear other factors in mind. Thank you. And I think that with the recent announcements made by our government with respect to significant Volkswagen investment and the production of electric batteries for electric vehicles, I think we're on the right track. Mr. Jean, earlier you talked about a recession that may be possible. Obviously, this concerns Canadians. But if we come forth with good policies and put ourselves on the right track and become a leader for tomorrow's economy, do you think, can we see what the economic forecast will be beyond 2023? You referred to our resilience earlier. Can I answer? Thank you, Ms. Chatel.
It goes very quickly, and maybe in the next chance. We're moving over to the bloc, and Monsieur Savat Tremblay, please, for 2.5 minutes.
Thank you. Thank you, Mr. Jean. I'd like to ask you about the real estate sector and the importance of increasing the construction sites. You talked about this. Can you elaborate further? Of course, we feel, as I said earlier, that we have to increase construction startups by 50% immediately. We need to be able to meet the needs associated with the demographic demand that I referred to earlier. We have a labor force that is very tight, so we don't have excess supply at the moment. And this is apparent in all of the major cities here. And when you look at demographics, you can see the need to build more housing. We have a pressing demand here, and if not enough efforts that put into this sector, well, the whole issue of affordability will be problematic, and our ability to attract talent from elsewhere will be decreased, because this is a whole issue with respect to the. This is an issue that's very important, and housing, affordable housing. I think, well, it's time now that we give some thought to our attachment to property. I think there are different models that we can see throughout the world where people are tenants, and that doesn't prevent them from saving for the future. But we get to a point, maybe this is a natural progression of society, where these choices become important, and we have to really think beyond the traditional model. I have 10 seconds, so I'm just going to say thank you very much for your comments.
Now we're going to the NDP and MP Blakey for 2.5 minutes.
Merci. Quand nous parlons de...
Thank you. When we talk about affordable housing, I think it's important to know that in the 30 years before 1995, Canada built with the provinces from 15 to 20,000 affordable housing units per year. And for the past 3 years, we've produced almost nothing, or at least seen almost nothing coming from the federal government. If we do the math, I think that we need about 500,000 housing units that are affordable. And if you multiply this by 30 years, I think that comes up to about 500,000 affordable housing units. So I'm wondering if it's possible, given that over the past 30 years, it's the market that was used to create housing. Is it possible to address the housing scarcity with market solutions, or do you think that we really need a program, a public investment program, to build affordable housing aside from that produced by the traditional market? Is the question for me? Yes. I would say we have to rely more and more on partnerships to do this and work with the private sector. If we expect the private sector to go it alone and be able to deliver the goods, it will be very difficult. We see, particularly in Quebec, that efforts are needed to develop more, to develop co-op housing models, for instance. We see very few of these models in Quebec. We see more of it elsewhere, but not in Quebec. We need to build housing for students, for seniors. we have to come up with multi-generational models as well, given the current demographics. And I think that we can't have this conversation without talking about labor, because construction is a very labor-intensive sector. 20% of construction workers are over 55 years old. And that's why, and this is a very physically demanding job. So right now, when you look at the immigrants that are being brought into the country, we need to have a clear strategy so that their skills meet the needs that we have. Thank you. Thank you, Mr. Jean.
And now we're moving to the Conservatives for 5 minutes, please. MP McLean, welcome back to our committee.
Well, thank you, and thank you, bank people as well. Mr. Marion, I'm sorry that you're not able. I've always found your comments very astute, so I'm sorry you weren't able to be heard here today. But let me ask a question of Mr. Gregory right away, following up on my colleagues' questions. Mr. Gregory, interest rates are going up. House prices are down an average of 14%. This is a double-edged sword for Canadian house owners in Canada. Can you tell us, when you talk about $350 billion in excess savings, how much of that is tied up in houses?
It's unclear where the bulk of those funds are sitting. I suspect that as these excess savings are being accumulated, some of those ended up becoming permanent savings. In other words, not available to be spent on a ready basis, either invested in financial markets or in housing. But it's not clear how much of
You're
that
right.
is actually
A good portion is housing. So your $350 billion, where does that number come from as far as date goes? Is it prior to the 14% devaluation in housing in Canada or after?
That amount of $350 billion, the way that's sort of calculated is that before the pandemic, Canadians were saving roughly about 2.5% of their income. And then the moment we hit the pandemic, the savings rate went well above that.
Yeah,
so anything above,
Mr. Marion, I'm asking you a direct question. Is your number $350 billion before the 14% housing slide or after?
Are you asking me the question? Or
are as of the fourth quarter of 2022.
Fourth quarter 2022, $350 billion. Thank you. Mr. Gregory, one more shot at this. In Alberta, people have walkaway mortgages, different from most other provinces. If that option was available in every other province in Canada, how much of a hit to the balance sheet of the banks would be taken because of the downturn in housing markets if Canadians walked away from mortgages they were underwater on?
I'm not that familiar with that particular aspect of the mortgage market. Therefore, I really can't really comment on that.
Okay, let me ask another question from your comments. When you spoke about a 2% last quarter inflation rate in Canada versus 5% in the United States, is this a blind spot or is this a pretense that inflation is much higher in the United States than it is in Canada?
Well, the 2% was really reference to headline inflation over the last 3 months. If you want to really compare apples to apples, you're looking around a 3% pace in Canada at core inflation, around 5% in the U.S. So there's definitely more stubbornness on U.S. inflation.
Okay, well, thank you. That's exactly what I'm asking here. Is it a difference in calculation or is it a difference in the effects felt by citizens in each country?
It's partly a definition, but also you have more sort of rapid wage inflation in the United States, and U.S. households have actually begun to tap their accumulated excess savings. So they're continuing to spend in the face of higher inflation, which is not the case for Canadian households. Hence, our inflation seems to be cooling off more quickly.
Would the Inflation Reduction Act, the Inflation Exacerbation Act of $360 billion U.S., be having an effect on inflation in the United States? And can we expect the same if we have another $50 billion deficit budget here next week in Canada?
Well, the Inflation Reduction Act, and to your point that the name is a little bit of a misnomer, but it does over time contribute to deficit reduction, and from that perspective, it could be disinflationary. Part of that, the Inflation Reduction Act dealt with keeping healthcare affordable, which of course helps keep inflation down, particularly healthcare costs. The other part of that, of course, are supports for the transition to clean energy.
Excuse me, Mr. Gregory, I'm asking a direct question. Can we expect the same inflation in Canada if we commit to spending tens of billions of dollars in this budget that's coming up next week?
That's a hypothetical question. I really can't comment on that.
Well, it ties into the whole nature of the fact that if the government's spending money, we're going to have to raise interest rates to keep inflation down. Do you agree?
It depends what is being spent on. Any money that's spent on improving the capital stock, improving productivity, actually helps the inflation dynamics over the long haul. So, as my colleague Mr. Jean said, it depends on what policies are currently being practiced.
Thank you, and thank you, MP McLean. And now over to the Liberals, MP McDonald, for 5 minutes, please.
Thank you, Chair, and thank you to the guests here today. And I'll jump on the interest rate issue of while they're paused, and maybe this will go back to Mr. Gregory. While they're paused, we know homeowners are feeling the pinch, but we're not witnessing the high number of mortgage borrowers in arrears. How would you characterize the stability of the housing market?
Well, I would consider the housing market. Obviously the market is weakening off. Prices are falling, activity is falling, and that will likely continue. But again, we're not seeing a lot of forced sales. Listings are falling alongside lower demand for homes. So it's kind of a sort of almost like a kind of a balanced situation as we move to lower prices, more affordable prices.
Do you suggest that the targeted spends by the federal government throughout COVID-19 and thereafter are playing a specific role in our ability to recover quickly than most other G7 countries?
When you kind of look at sort of the global picture and you look at the extent to which governments around the world provided support for their economies, Canada and the United States, for example, were near the top of that support, which I suspect helped in the how quickly we recovered. Of course, we had restrictions in Canada were a little bit longer lasting than a lot of other jurisdictions, so we may not have seen that yet in the numbers.
Correct itself. We're starting to see investors trying to move away from market investments in housing like REIT. And if yes, what's this do to the local economies or the residential aspect of housing?
Well, part of the reason we ended up with such a frothy housing market in part was because we were getting an increasing role of investors, not people who were sort of home owner-occupied purchases, but people who were doing that as an investment, either to sell it down the road or rent it out or whatever the case may be. And usually that arithmetic of that decision depends on how much it costs to borrow the money, what are the prospects for potential capital gains. Well, as we know, home prices have been falling, so that particular aspect of it has been moving in the wrong direction. Of course, borrowing costs have gone up quite significantly. And so I think not surprisingly, the housing market has cooled off in large part, or at least a significant part, due to the demand from an investor demand for housing cooling off.
And finally, maybe, larger companies are deferring payments and redemptions or limiting withdrawals on the market side, which you just indicated it could have a strong possibility of affecting our local economies and possibly helping our housing market at the residential level. So in that scenario, do you feel that more people now are starting to invest in decarbonizing, companies that are looking at decarbonizing investments?
Well, obviously, when individuals are making their investments and they're looking sort of opportunities down the road, and clearly anything I think in the sphere of taking advantage of this transition we are going to make to zero carbon, zero neutral carbon is going to be where a lot of the activity, where a lot of the resources in the economy are going to be diverted over time. So you just have to look at what's happening in the mutual fund or ETF industry, where funds are being created where investors can take advantage of that, and they are.
Quickly, green bonds issued. There's been a majority made by corporations, but accumulatively by financial corporations to date. And it seems to be that there's some confusion on the green projects that are being evaluated by investors because of that scenario. And I'm just wondering, is there anything that the banks can do to correct that? Because investors are not necessarily knowing which are the green projects to some extent, because the banks are coming in as a lead, as second, but a lead in the financing on the whole project.
At the end of the time there, so
Okay.
they might have to come back to that question and answer in a later stage. So we're into the third round, members. I've got MP Fast is up right now for 5 minutes. Welcome back, MP Fast.
Well, thank you. It's great to be back at this committee. And I'm so glad to see that Mr. Marion is back online. My questions will be focused on him. And I'm
MP
so
Fast,
glad, Mr.
Just
Marion.
before you commence, MP Fast, so we do have Mr. Marion listening, but still the sound, the interpreters, it's not possible to have Mr. Marion. But you can pose the questions,
Really?
and Mr. Marion can then send the questions back in writing to this committee as we've asked. And we apologize, Mr. Marion. It's just we experienced some significant technical challenges, and it is just not working with interpretation. So
Okay, so
MP
you can't
Fast.
hear me.
Yeah, MP Fast.
So it's very clear that Mr. Marion cannot speak to us?
Mr.
Because he
Marion
does have a
cannot-
headset
we
on.
do, no, yeah.
I
But
can
the
speak.
interpretation is not getting any clear, they're not getting clear sound interpretation. That's my understanding. Interpretation is
rebooted
not
my
getting clear
machine.
sound for whatever reason.
I'm hearing him right now.
Yeah, interpretation,
I
MP Fast,
understand.
yeah, it's not the members. Interpretation is not getting clear sound, and they're not able to do their job. So we cannot continue with Mr. Marion. But what we apologize for the technical challenges, but Mr. Marion, what we would like is that you send in your opening remarks that you had for us, and the clerk will distribute to you all the questions that have been asked here, and you have an opportunity then to give responses back for our report, for the analysts, or whatever, to be able to do their job. MP Fast, please.
All right, I will address my question to Mr. Marion because I was very pleased to see that after we had a discussion about the various impacts that affect inflation in Canada, such as the war in Ukraine. We talked about supply chain constraints. We talked about excess savings, the Inflation Reduction Act. Mr. Speaker, I was glad to hear that Mr. Marion actually got to the nub of the issue, which is something that we actually have control over in Canada. That is our productivity. I'm going to ask Mr. Gregory, what impact does our lagging productivity in Canada have on our ability to address inflation on the supply side?
Well, when you look at sort of our poor productivity performance, it's also sort of matched with whatever kind of wage inflation we're seeing. Because at the end of the day, what drives the inflation process is not any particular pace of wage inflation, but the extent to which it's above and beyond the pace of productivity, what economists refer to as unit labor costs. And to the extent we have poor productivity performance, that does sort of contribute more to an inflationary dynamic with respect to wage gains. Another aspect of that as well is the competitiveness. The more productive we are as a society, not only does it help sort of dampen inflation pressures over time, but what it also does, it makes us more.
Oh no.
Okay, now Mr. Gregory is gone, Mr. Chair.
Gregory, are you there? Can you hear us?
Chair, I just want
And
a
you have
point of
your,
order.
your
Point of order, Mr. Chair.
point of order, MP Morantz?
The technical difficulties are encumbering the committee's ability to do its work today. My understanding was that all witnesses were supposed to be tested in advance of the meeting and to ensure
So,
that they would be able to respond to
MP
our questions. I'm wondering how it's possible then that Mr. Marion is unable to participate in this meeting.
Yeah,
and,
that's
and who's responsible for letting that happen?
Yeah, that's a great question. So we did test with Mr. Marion. We were having challenges right up to the time that we started the meeting. We were hoping that those would have been rectified. As we can see, they were not. And we've heard from interpreters that is they cannot get the sound to be able to do their job in a safe way and to be able to do their job effectively by getting all of the interpretation correct. So so the decision was made as is our protocol to not have Mr. Marion, although we apologize for the technical challenges, but we do the testing, MP Morantz, before, and we try to do the best we can with the witness. Sometimes it's internet, sometimes it's just computers. I understand, and I'll just share with members that Mr. Marion's computer was going through an update right before it's just started an update. That happens. It's happened to some of the members here, and those are the things that take place. You know, we don't have full control over technology, and sometimes it does let us down. Although I have to say, in many of the meetings that we've had here, and I've stopped the time. So many of the meetings that we've had here in our committee, in all committees, and through the House of Commons, with the ability to use internet and the technology that we have before us, we've been able to bring in amazing witnesses from really right across the country and right around the world. You know, our last meeting we had witnesses from Paris, France, and Stockholm, so that were here with us. So that's where we're at right now, MP Morantz. So on that. But I'm going to go back to MP Fast. We did stop the time. We still have two plus minutes. Yes, MP Chattel, point of order.
Thank you. On this point of order, I just want to say I have great empathy for the extraordinary work of our translator. But I have also great empathy for having Mr. Marion coming to our committee, having great things to share with us. And this committee is under a very difficult study on inflation, a matter that Canadians care greatly about. So I understand both sides, and my heart goes to both. But Mr. Marion, I just on behalf of the committee, say how sorry we are all not to be able to hear you, and be certain that your comments in writing will be part of our report. And if there's anything else we can do to have Mr. Marion's back, yes. Thank you.
Okay. Another point of order, MP Fast.
Actually, on the same point of order,
yes.
I think what Ms. Chattel has suggested implicitly is that we have Mr. Marion back. I spent some time reviewing each of our witnesses' comments on the economy and on inflation, and I wanted to focus my questions, direct them to Mr. Marion. He's not here, or he's not able to respond. I would really appreciate it if the committee could call him back, whether in person or with proper translation confirmed.
Yeah, thank you, MP Fast, MP Chattel, MP Morantz, and I think you speak for all the members here. Of course, we would love to hear from Mr. Marion virtually, but even better, we may have an opportunity to, if Mr. Marion's schedule allows, to even come back in person and to be here before our committee at a future meeting on inflation. So that may be something that is possible, but in the meantime, you know, what we're trying to do is allow Mr. Marion still to send in his opening remarks, as well as have an opportunity to answer in written many of the questions that have been posed here today during today's meeting. But I think good comments from all the members. Like I said, we want this to work as best as possible for the witnesses, for the members, and for everybody, really, technicians, interpreters, the clerk, the analysts. So right now, MP Fast, you were at 3 minutes. Is what you got a couple more minutes to ask questions, please.
Sorry,
All right,
just,
thank
one
you.
more point of order. I'm sorry, Mr. Chair.
Another point of order.
Mr.
MP Morantz.
Gregory dropped off.
What's that?
I think Mr. Gregory dropped off. Am I correct?
Okay, yeah, I
So
do
is
not
there-
see him on the screen
Yeah,
right now, so we're
so-
holding on the time.
So my question is, are efforts being made to reestablish contact with him? Has anyone reached out to him to find out what's happened?
We will check on that right now. So, okay, we have been calling, and we're seeing. I don't know if. No, I don't see him. I don't see him on the screen. Yeah. Well, what I've just been. His internet has stopped working, MP Morantz. So yeah, so it's. I guess it's again. Like I said, we have a lot of technical challenges are going on today. I don't know what is happening, but yeah. So the internet is not working, and for Mr. Gregory, so we have Monsieur Jimmy Jean. We have Monsieur Jimmy Jean, and we've got two minutes for MP Fast before we move to the next questioner. MP Fast.
All right, to Mr. Jimmy Jean. Mr. Jean, would you agree that Canada's productivity is lagging?
Poor guy. Certainly, I think, and having worked on this topic in a good part of my career, there are many reasons that productivity has been identified to be lagging versus the United States. I think the chief reason is our lack of dynamism on the innovation front in terms of our track record in being able to commercialize new innovation and make them viable businesses. That's where the U.S. has done such a much better job than we have. For sure, they have a deeper venture capital system, very vibrant universities. And so do we, but that's the key issue.
I'd love to hear your comment on the impact which declining private investment would have on our productivity and in our competitiveness.
Right. Well, and that was actually my second point on business investment. We've for a good number of years, we've had our business investment relying heavily on investment in the commodity space, and that's served us well in terms of generating growth. But we've seen a lack of investment in information and communication technologies. It was quite stunning when the pandemic hit, and you look at how the U.S. responded. All of a sudden, people needed to work from home. Businesses had to invest massively in their capabilities on that front. Have you seen that pick up in information communication technology investment? We haven't seen that quite to the same extent here in Canada. Moreover, we're in a phase, obviously, with the aging of the population, where businesses need to gain resilience against that demographic shift. And one of those ways is automation. We are not seeing the same level of dynamism on this front in Canada as we are seeing in the U.S. And that's a key factor that will allow companies in Canada not just to stay alive, but to actually compete. Because all of a sudden, if you have companies in the U.S. that are fully automated and that are able to produce at much cheaper cost, they're going to come after our market share. So that's also an issue that we haven't seen much traction on in Canada, and that is a worry for us.
Thank you, MP Fast. And now we're moving to the Liberals, and I've got MP Sorbara for 5 minutes, please. And I do understand that it is from Mr. Gregory's side. It's a firewall issue that has gone up on his computer from his side, and that's what has blocked Mr. Gregory.
I'm sorry, I take my sound days back if you want. I take my sound days back.
Oh. Yeah, Mr. Marriott, yeah. So MP Sorbara, please, for 5 minutes.
Chair, just for clarification, can we ask questions to Mr. Marion now?
No, because interpretation is not working.
Okay. Thank you for that clarification, Chair. I'm going to ask it this way. Mr. Marion, if you can just do thumbs up or thumbs down on your answer, okay? The first question is, with regards to what's happened in the United States and with regards to the banking sector and the Federal Reserve, again, being the backstop to the banking sector, has the credit origination, are we concerned at all about the amount of credit origination that we know fuels much of the economy has been impacted? You can just go yes, we, or no. We. Thank you. And to Mr. Jean, to Mr. Jean, excusez-moi, je ne parle pas bien le français.
I apologize, I don't speak French well.
To inflation here in Canada, inflation is usually divided into goods inflation and services inflation. Are we seeing both a deceleration in inflation on the good side and the services side?
I would say we're seeing it mostly on the good side. It's and especially on the energy side. I would say energy is the main contributor to the disinflation so far. When you look at food, obviously it's pretty sticky, and when you look at one measure of core inflation, which is inflation excluding food and energy, it hasn't moved that much. It's stopped accelerating since last summer, but it hasn't moved that much lower. So yes, I would say in goods, and that's related to what we're seeing internationally in terms of the easing of supply chains. But in services, and in particular, what central banks are going to be focusing on is services excluding shelter, which, as Mr. Gregory mentioned, is seeing the effect of higher mortgage interest costs, and we expect that to continue. The contribution of shelter will be very sticky compared to, and certainly higher than what we've seen prior to the pandemic. So that means the Bank of Canada will need to see services inflation slow down quite significantly if it hopes to bring inflation down to 2%. And that will likely be the tricky part. We expect 2.5%, 2 to 2.5% at the end of this year. That's going to be the low-hanging fruit, but going the full way to 2% will be more difficult because of those factors of stickiness.
And I have one more question in terms of more of a philosophical side. It was referenced, I think, by Mr. Gregory, I believe, with regards to the cost of money. And I've fundamentally believe in this from 08, 09 and the great financial recession, the great financial crisis, which the world went through up until now. Would it be fair to state, and there was a great documentary on this last Sunday night on PBS, that the age of easy money is now over? Mr. Marion, can you just go up or thumbs up or thumbs down? Thumbs up. Thank you, Mr. Marion, for agreeing to that. And Mr. Jean, would you also agree that the age of easy money is now over?
Yeah, I agree. This is exactly why we're seeing some banks struggle. We have a whole ecosystem, banking and global financial market ecosystem, including here in Canada, that's been structured around the idea of low interest rates forever. Now that paradigm is changing, and we're seeing the ramifications. And given the inflation scare and the long-term pressures there's going to be on inflation from various structural sources, it's going to be very difficult for central banks to bring in, financing conditions back to where they were.
So, and I would add that the idea that you do not hear at all bantered out about on modern monetary theory, and I have my graduate degree in economics and studied monetary theory. You don't hear anything about MMT anymore because it was an idea. Thank God, exactly. It was an idea that was brought upon because rates were and money was. I would say at too low levels for a long time, and now that the age of easy money, and as Warren Buffett would say, when the tide goes out, you see who's not wearing shorts, if I can use that term. So I thank you, economists, for agreeing on that statement.
And it left MP Baker.
I'll take the rest of the time if I may, Chair. Monsieur Jean, je reviendrai.
Mr. Jean, I'd like to go back to you. And I'd like to go back to a subject that was dealt with earlier. Although the GDP in Canada has slowed down at the end of 2022, the labour market continues to be resilient, and Canadian spending remains robust. What impact has this had on our economy? Well, this is the past. As you talked about the consumers, in the third quarter, we had a contraction of the GDP in Canada, a strong drop in consumer spending. So there are impacts here, and what we know is that the delays are variable. So the maximum effect we've seen in March 2023, we saw an increase, but we haven't yet reached the period where we had a maximum. So that's why this 75% increase is talked. So the impacts are still being felt. The resilience in the labor market or consumer spending doesn't teach us much about anything. If you look at, for the average mortgage, it goes from payments are from $1,500 to over $2,000. So it becomes extremely prohibitive for a lot of people. There are some people who are very sensitive to the slowdown, and it has an impact on their interest payments and on their income itself. Thank you.
And just before we go to the block and Monsieur Sava Tremblay, I just want to another update. So it's the entire BMO Capital Markets is got some firewall, and the whole department is down. So just be aware of that. Now, that being said, I just want to say the clerk and his team do an incredible job in terms of inviting the witnesses that we put forward to the clerk. And that being said, but when we are inviting these witnesses for over the last while, we've done that we just give them the option to be able to do it virtually. With members' indulgence, I can ask the clerk to emphasize that it would be better to have them here in person. So we will do everything we can to bring them here in person. So the approach that we've taken is they have the option. The witnesses, and we're grateful for the witnesses coming before us today virtually, but we can see that where we do have technical challenges, members really want to hear your testimony for our report. So we will do that going forward. We'll use that practice that we will emphasize to try to get people here in person, because there's nothing beats in person, right? I think all members would agree with that. Okay, great. So we're going now to the block for 2.5 minutes. MP Sava Tremblay, please.
Yes. I'm sorry, I was just swallowing my last mouthful. Mr. Jean, please. One blink means yes, 2 winks means no. This is a joke. We're not going to be using sign language here. When you said that you were anticipating a recession, a moderate recession, in the case of Quebec, you talked about all of Quebec, but in Quebec's case, what is your forecast? What do you see in your crystal ball? And what is the sector most at risk? In terms of base forecasts, I think that we'll have a temporary recession, particularly with what's going on in the United States and the ramification on the economy. So I think it will be a moderate recession. To answer your question specifically, Quebec, there's been negative growth. There's been a contraction of the GDP in Quebec, and in Canada it's 0.6%. But as far as Quebec's concerned, we're not more exposed to risk, and there's connection between the housing starts and the real estate market. So there is a lot. Consumers are being extremely cautious and they are not buying big consumer goods. In fact, there's been a record level of consumer spending in terms of it being very, very low. We're avoiding catastrophe for the moment, but this will all have an impact on the labor force. But there are many businesses that are better positioned, however, to retain workers, or they're able to get talent elsewhere. So it's mitigated. But I don't think that this is something that's going to be avoidable either for Quebec or anyone else for that matter. Thank you, Mr. Jean.
Okay, and now to MP Blakey for the NDP for 2.5 minutes.
Thank you. Mr. Jean, just following up on that theme of recession, wondering, I'm wondering how recession ready you believe Canada is. I mean, we know that automatic stabilizers can help a lot in the case of a recession, particularly when we start to see higher levels of unemployment. We know that the government recently kind of took the employment insurance system out at the knees when they ended the temporary pandemic measures in September without replacing it with a proposal for a modernized EI system. So we hear that a recession is coming. We know that EI is not ready. We don't have a timeline on when the government is going to replace it. I'm just wondering, in respect of EI or other measures that you think would help mitigate the negative consequences of a recession, how recession ready is Canada? What are some of the things that the federal government could be looking to do to better prepare the country for recession?
And in the question, there's the question of mitigation. Do we really want to mitigate or prevent a recession? I think that's a fair question to be asking, because I actually happen to believe that a recession is necessary to rebalance the economy, as Mr. Gregory mentioned. This is the fundamental problem is that demand and supply are in balance. So a recession is typically the only the solution that we know works to get those parameters into balance. For sure, we don't like the idea that...
I'm sorry,
yes.
I'm just going to interject and say, I think that's easy for a lot of folks around this table to say, but for the people who are going to bear the brunt of that in terms of their household finances and their children's future and all of what that means for individual Canadian households, as a policymaker in Ottawa, I do feel an obligation to try and understand how we might mitigate those very real and negative consequences for Canadian households. And even while we experience recession, and that may help better align supply and demand, we want to do it in a way that maximizes the number of Canadian households that come out the other side solvent and ready to take advantage of the post-recession opportunities. So I'm wondering if you might be able to speak a little bit to what things we can do in order to encourage that outcome.
In a very, very short answer, please.
Well, I would say certainly improvements to the EI system to make it broad and inclusive, such as the, in line with the ideas that were put forward during the pandemic. That would be certainly one way. We don't have the same type of job market that we used to. We have a lot of gig workers, things like that, so make sure that they're included. Having said that, we also have realities coming off the pandemic in terms of our debt, in terms of our deficits. So we have to be mindful for that. We saw what happened in the UK. We certainly wouldn't want something like that to happen here. Like I said, I think structural conditions make it such that we can avoid a very bad recession, largely because of our tight labor market and population aging.
Thank you. And thank you, MP Blakey. And now over to MP Morantz for 5 minutes, please.
Thank you, Mr. Chair. I want to speak to Mr. Marion. Are you still there, Mr. Marion? I see your screen is blacked out.
Yeah, you could pose questions to Mr. Marion.
Oh, there you are. Thank you. So I'm going to... great thing about this situation is I get to talk, and as a politician, that's never really been a problem for me. So I'll just pose my questions to you. And I apologize again for this, but if you would be so kind as to respond to them in writing to the clerk of the committee, just give a thumbs up if that's all right with you, Mr. Marion. Okay, so my first area I want to touch on is the link between fiscal and monetary policy and interest rates, because I see this as a continuum, and I think back to what happened. For example, there's many historical examples, but what happened in the Weimar Republic after World War I, where we had hyperinflation because of essentially loose money monetary policy. So in Canada, what we saw is the Bank of Canada embark on an historic plan, a program of quantitative easing and acquiring bonds in an attempt to keep interest rates low. We saw the Government of Canada spend over $500 billion in deficit over 2 years. I myself had a chance to question Tiff Macklem in committee a couple of months ago, where he confirmed that if government spending had been less, inflation would have been less. Now, the reason this is important is that when inflation takes hold, central banks really don't have a lot of options in terms of how they can get that under control. They can increase interest rates and try and sell off some of those bonds that they acquired, what they call quantitative tightening, in an effort to reduce the money supply that they had spiked through their easing program. And so I'm just wondering if you could respond in writing as to whether or not you generally agree with that analysis. So that's my first question for you. My second question for you has to do with when there's daylight between the overnight bank rates in the United States and Canada, what effect that has on the Canadian dollar. And so my understanding is that when the overnight rate in the United States is higher, the return on bonds is higher. And so you'll see capital migrate to where they can get the best return, which means that that would reduce demand for the Canadian dollar and likely weaken the Canadian dollar. Now, there's only a 1/4 point spread right now, but what I'm concerned about is if Mr. Powell decides to continue to increase interest rates in the United States, and we heard that demand is a little more stubborn in the United States than in Canada. So he has not taken off that table, and we're in a pause situation right now. At what point would daylight between the two overnight bank rates cause a flee of capital from the Canadian dollar to the U.S. dollar? That's my second question. And my third question has to do with foreclosures, because we haven't really been able to get a straight answer on this. But, you know, we have like really the perfect storm. We've got negative amortizations. I had never heard that term before. People are making their payments, and yet the amount they owe is going up every month. We have housing prices that spiked and dropped dramatically. We have, from all indications, an impending recession. Some think it might be mild. Certainly a slowdown in the economy. So I'm wondering if you could maybe provide your opinion as to whether or not you think that this will cause a spike in foreclosures, if more Canadians could be losing their homes because of this, and what the impact of that might be on their personal finances. So is that 5 minutes? Only 3:37? Well, that's all I have to ask. Those are my three questions. So
Okay.
would it be okay, again, Mr. Marion, if you could respond to those three things in writing?
Okay, we do have,
Of
okay,
course,
thank you,
I
Mr. Marion.
can,
Yeah.
Of course, I can do that. Yeah, I can do
Okay,
that.
thank you very
Thank you.
much.
And we do have witness, Monsieur Jimmy Jean.
Oh, Mr.
Yeah,
I'm sorry,
yeah.
Mr. Ron, since I have another minute or so,
Yeah,
can
you do.
answer all three of those in 60 seconds?
Thank you.
Or pick one.
Well, I would say I can comment on the Canadian versus U.S. interest rates. I would say, first of all, it's not unusual and it's not unexpected because markets are quite positioned for that. We've seen the Canadian dollar weaken, not directly as a result of the policy differential. As I said, it's not unusual. You see that in every cycle. Every cycle, when we're at the end of the cycle, interest rates are higher in the U.S. than they are in Canada. But right now, the Canadian dollar is weak and the U.S. dollar is strengthening because of risk aversion. And we've seen that also during the pandemic. The second thing is our household debt realities here in Canada, which are much different from those in the United States, as we discussed earlier. So because of that, the Bank of Canada cannot, each 25 basis point hike bites more here in Canada than it does in the United States. And the third point I would signal is that the quantitative tightening that the Bank of Canada operates right now, our research demonstrates that it's more biting here in Canada than what the U.S. is experiencing this year because of technical reasons related to the debt ceiling. But in other words, this is another way, even if rates are constant, that the Bank of Canada enacts tight monetary policy is through quantitative tightening, and that hasn't stopped. So for all these reasons, I think the dosage of tightening that we're currently seeing in Canada is appropriate, and the Bank of Canada needs not worry overly about what the Canadian dollar does in the very short term.
Mr. Jean and MP Morantz, you got a lot out of that minute, and now we're over to the Liberals and MP Châtel, please, for 5.
Merci beaucoup, Monsieur le Président. Merci encore une fois, Monsieur Jean.
Thank you, Mr. Chairman. Thank you, Mr. Jean. With all the technical problems we've had, we're lucky to have you here. If I may, I'd like to go back to where we had stopped off earlier. You alluded to a recession, a light, temporary recession. That's reassuring. What should we expect from the economic recovery in 2024? A recovery that should be equal to 1.4% after 0.6%. Pardon me. It is 0.4% in Canada, and it was 0.6% in Canada. So there's an acceleration. What we're seeing from these figures, it's not what we saw in the past, a rebound of 3 and 4% happening when a recovery kicks in. The reason why it's this way is that we have interest rates that are still high. We don't have a very accommodating interest rate right now, given that the Bank of Canada has been concerned by what's happened in the past. So the interest rates will only converge where it stops hurting the economy. That's why we will have a recovery that will be slow. Inflation, which was the target, could justify a reduction, but we don't have this scenario right now for the factors I alluded to earlier. The good news, however, is that the labor market has leveled off. We have a 0.9% unemployment rate. We see an improvement in income at that point, and that will allow households to breathe easier. So the real rates will increase, will be positive after 2 years of real rates that are negative. So there should be an upswing in spending, particularly in the real estate market. And thank you, Mr. Gregory, when he answered my Conservative colleague, he talked about strategic spending and the potential of Canada. This is a measure that fights long-term inflation that will help us stimulate the economy and increase income and GDP. Could you please elaborate on that? Yes. I think he was alluding to investments such as, well, we talk a lot about those investments in infrastructure, transportation. This measure has been shown to have an impact on productivity, and there is a lack of investment in information and communication. And given the current situation, as I referred to, we need to repatriate our manufacturing to make our economy more productive. And allow us to carry out the transition. It doesn't mean that we're going to add a lot to productivity, but that does lead to a more stable economy if there is less climate change occurring. So all of these factors together have an impact on productivity. But I would also add, and I agree with Mr. Gregory, that the type of measures that we need to put in place, well, we're no longer in income support now. This isn't the only impact on inflation, but that is part and parcel of it. We need investment in capital. We need an economic cycle that's based on investment and international competitiveness in the technology sector is very important. We have to turn to that in order to increase our productivity. Thank you. And if I may, all of these points are relevant. Could you submit them in writing? Because this is so fundamental so that we can make strategic investment to put Canada in a good position and enable us to have a competitive economic recovery.
That is kind of our time. We do want to thank our witnesses. We want to thank Monsieur Jimmy Jean for the heavy lifting. I know you had to do a lot of it here today and thank you for your internet working so well. And Mr. Marion,
all the trouble in the world
yeah,
getting it fixed during the setting. So.
There's some things we have no control over. Mr. Marion, thank you very much for still participating as in terms of listening in and for then providing your remarks and your answers to the many questions that have been posed. And we did lose Mr. Gregory to internet connection, a firewall, I guess, at the bank or something that went up, and their internet is down. So they say when it rains, it pours. But we do want to thank our witnesses for their testimony, for participating in this study on inflation in Canada's current economy. And on behalf of course, the clerk who reaches out to everybody and the technicians and the analysts and they do an amazing job here. I could tell all the members in terms of the links that they go to bring in witnesses and to get them here before us. And we love to see them when they're in person, but we do have them here today, some virtually, and we will look to bring some back for future meetings. So thank you very much, everybody, and this adjourns our meeting.